So did anybody, if you could show, raise of hands, did anybody go to the economic forecast in October? OCBC, gosh, only a couple of people. Okay, well that's good because that one was a little bit dismal. This one is going to be a little bit more optimistic. So we will be convening probably about 15-20 minutes to start the program, and you can enjoy your lunch. So thank you. In your everyday running your business, whether it's marketing, if you're looking for access to capital, possibly looking for some working capital in order to implement a contract, looking to get a contract and maybe do some business with the government or local corporations. Your nearest Small Business Development Center can help you out, and we have the Orange County SBDC here. Or you can check with myself, Sean Snyder, who's our Associate Director, or Iris Miranda or Janelle Valenzuela are out at the registration tables. Give them your cards, and we'll make sure we take care of you and your business here in the domestic market. I would like to, of course, say thank you to our sponsors. Rancho Santiago Community College District, I'd like to actually bring up my fearless leader and my boss, Dr. Anil Puri.
Good afternoon. It's my pleasure to welcome you to the second annual Global Trade Summit, as Priscilla pointed out. And hasn't she done a great job of organizing this? Let's give her a big hand of applause. She knows how to bring people together and make things happen. She is the director of our Small Business Development Center at Mihaylo College of Business and Economics. A college and a university, Cal State Fullerton, committed to the growth and well-being of Orange County and Southern California. That's our mission, and that's our vision. And we do that through educating the young people of our region and doing research, collaborative research, targeted to the issues of our region, with the best that we have to offer our bright faculty members and our students. So I'm very proud to be a part of this wonderful institution. And this event and the study whose results you're going to listen to in just a few minutes are the examples of the commitment that Mihaylo College and Cal State Fullerton have to this region. Education is under all kinds of stresses today, financial and otherwise, but our faculty are committed to staying the course, doing their best in the classroom and in their labs. And it's my great pleasure today to introduce two of our brightest faculty members in the economics department, my home department, Mira, Farka, and Adrian Fleissig. Both have outstanding credentials, not only as academic economists, but also in their ability to do rigorous research and make it relevant for the practical world. And that's what they're going to do today. They're going to share with us the results of their work that they have invested a lot of time and effort into. And I'm hoping that with the support of the community, support of businesses in this area, we can continue to do this annual event and do the forecast every year. So with no more words, let me welcome Mira and Adrian to the stage. Thank you.
Well, thank you, Anil, and good afternoon, everyone. Hope you're having a good day. Well, Larry Summers once said that you can't repeal the laws of economics, even if they're inconvenient. So let me actually rephrase this a little bit and say, you actually can't repeal the forces of globalization and international trade, even though they may be inconvenient at times. Globalization and international trade is here to stay. It permeates our everyday life. And we'll argue here today that it's a vital part of our regional economy, and it can actually be the key for the national recovery going forward. In fact, the Los Angeles metro area is a major player in international trade. It has been so for a long time, and it continues to be. International trade supports economic growth. It supports jobs, a large number of jobs in the area, as you will see. However, one thing is that imports are bigger. In fact, imports are twice as large as exports in the area. But we'll argue here today that for long-term growth, the important thing for long-term growth is for the region to actually expand further its role in exports. And we'll show here that, in fact, the LA metro area has the right fundamentals in place to do so very successfully over the near term, and in fact, it has the right fundamentals to actually lead the nation in exports going forward. So with that in mind, let me actually run over the main topics for you today. So first up, I'll talk about the big picture. First we'll take a look at the global economic trends. How's the world economy shaping? Where have we been? Where are we going? And then I'll take a second look at, sort of a closer look at the regional economy and its role in international trade. And finally, I'll narrow things down at the regional level and talk about our analysis and forecast for exports for the LA metro area. So these are sort of things that I want to cover. Finally, Adrian will come after me and talk and narrow things down even more to the Orange County level and present to you economic analysis and forecast for Orange County by country, by volume, by regions, by sectors, as well as talk a little bit about the methodology that we've used. And then we'll be very happy to take a few questions. So first up, let's take sort of a broader perspective, sort of a more futuristic view, and kind of take a look at, how is the world economy shaping up? Where are we coming from and where are we headed? And this first graph sort of makes exactly the following point. It shows global economic output in 2000, in 2010, and estimates for 2050. So where are we going to go by 2050? And here's for the main countries. In 2000 and 2010, the US and the European Union, the EU, were the biggest countries in terms of economic output. 10 trillion in 2000, about 15 trillion apiece in 2010. But I actually wanted to pay attention to India, China, and Brazil, the big countries. Now, in 2000, their combined output, in terms of purchasing power basis, their combined output was about half of the US. By 2010, their combined output was larger than the US, about $16 trillion. US was about $15 trillion. By 2050, the world is going to look very different. The US is actually going to be the third largest country in terms of the size of its economy, behind China and behind India. In fact, Brazil, as you can see there, will actually be ahead of Japan. Now, and here, the next slide sort of makes a point why focusing on international trade and specifically on exports is very important. 95% of the global demand is outside the US. Only 5% is in the US. In fact, emerging countries, specifically emerging Asia, has actually a large and growing middle class. This shows the share of middle class of the world middle class by areas. Asia Pacific, as you can see, in 2009, only 28% of the world middle class resided in Asia. 36% in Europe, 18% in North America. By 2030, 66% of the world middle class will reside in Asia Pacific. Europe will only make up for 14%. North America only for 7% of the world middle class. And more importantly, as this middle class, as the emerging market middle class grows, especially as the emerging market of Asian middle class grow, what happens is their buying power, their purchasing power, and their demand will also grow. In fact, again, here in 2009, only 23% of the global demand came from Asia in 2009. 38% came from Europe, 26% from North America. By 2030, again, keeping sort of a futuristic view, by 2030, close to 60% of the global demand will come from Asia Pacific. Only about 20% from Europe, about 10% from North America. This is a great opportunity for us. This is a great opportunity for us to actually create a presence, expand our presence in emerging markets, specifically in Asia, because a large and growing Asian middle class, a wealthier Asian middle class, means a larger market for our product. So this is a very important goal that we need to achieve. In fact, the National Export Initiative that the administration has put together, it's a great goal, it's a great step forward towards this goal. The goal is to double exports over the next 5 years. Now, this is kind of hard to achieve because we've only doubled our export 3 times in our nation's history. Last time we did this, it was in 1949, and that's because prior to that, we had a World War, I mean, it was special circumstances. But it's important to understand that expanding our role in emerging market, and especially Asia Pacific, is important. Any increase in exports will prove beneficial to the US economy and will prove beneficial to the recovery as well. But the problem is that we've actually fallen behind a little bit. Here, as you can see, the US, the exports make up very small percentage of US GDP, only 12%. For other countries, this is a lot larger. For Germany, exports make up 47% of their GDP. For China, 38%. For the UK, 27%. US is falling behind in this goal of actually keeping up with exports. And here's why exports can actually be important. Exports can be specifically important after the Great Recession, after the recession we just experienced. And in fact, by some account, it's not even over yet. Number one, there are 4 main things, there are 4 main factors that actually help economic growth: consumption spending, business investment, government spending, and exports. Let's take all of them one by one. Consumption spending going forward is unlikely to help much, and the reason being is because consumers are facing formidable forces. I mean, they have to deal with a multi-year deleveraging process. They have to deal with a housing market collapse. They have to deal with a very weak labor market. So again, consumers are unlikely to help going forward. Business investment. Business investments have actually helped quite a bit. The problem is that most firms have already replaced their old and worn-out capital. Therefore, business investment is expected to moderate going forward, so it's not going to be a force for the recovery. Government spending. Well, government spending cannot get any bigger given that we have huge structural issues with our budget, and we'll actually have to face them going forward. In fact, government spending could be an issue that we'll have to face and we'd have to deal with over the next 2 decades, 2 to 3 decades. So this leaves exports. And every effort should be made for us to actually expand our exports because it can help both our regional economy, as I'll explain in a minute, as well as nationally. It could be a key to get us out of this recession and into a more stronger recovery. So let me actually kind of take a look now at the regional economy and its role in international trade. As I mentioned earlier, the LA metro area, which includes Orange County, it's already a major player in international trade. I'm just going to put this in context a little bit more right now. But the LA metro area includes Orange County. The first thing that will help is to kind of give a broader overview as to how big is the area, what is its GDP, how does it stand versus the world. And here I'll talk first about the broader metro area, and then I'll narrow it down for Orange County. So first of all, the LA metro area is the 13th largest in the world in terms of population. It got close to 13 million people, the 13th largest in the world. Is the 2nd largest in the US, second only to the New York metro area. In fact, if it was a separate state, it will be ranked 6th ahead of Pennsylvania, so quite a large population. In terms of GDP, because again, it gives a sense of how large is the economy and how large is the population. In terms of GDP, or what I would call the gross metropolitan product, the GMP, in terms of its GMP, it is ranked 2nd in the US, again, behind New York metro area, and it's 1st in California. The GMP from LA metro area in 2010 was about $738 billion, so it's quite substantial. If it was a separate country, if this area were a separate country, it would actually be ranked 17th in the world, behind the Netherlands and ahead of Turkey, Indonesia, and Malaysia, and a bunch of other huge countries, Switzerland, a bunch of important countries. What about Orange County? Orange County is the 6th most, in terms of population, again, huge presence, 6th most populous county in the nation. It's 3rd in California. If it was a separate state, it will rank ahead of Iowa, so it's quite, again, large population. More importantly, it's important in an economic sense. Orange County produces about 100, in 2010, the output from Orange County was about $182 billion. That's actually quite sizable. If it was a separate country, if Orange County were a separate country, it would be ranked 45th in the world ahead of Singapore. So again, huge presence, both domestically as well as internationally. The area, as I mentioned earlier, has huge presence in exports. In fact, the LA metro area, the broader one, which also includes Orange County, is the third largest exporter in the US. In fact, the area originates about 5% of total US exports. 5% of total US exports, close to 5%, 4.9%, close to 5% come from this region. And it ranks third behind New York and Houston metro area. However, it's interesting to note, if you actually, this is in terms of merchandise trade, which is basically the goods exports. If you actually zero it down, if you actually include services on top of the merchandise exports, we actually rank second in the nation in terms of both goods and services. Now, but this is in terms of US. Within California, the vast majority, the bulk of exports from California come from LA metro area. We are the largest. We rank first in California in terms of total exports. And Orange County, surprisingly, and kind of nice to see that, Orange County, despite its small size, it's ranked third in California in terms of exports that originate here. So it's larger, in fact, it's actually larger than San Francisco. It's larger than San Diego in terms of the exports that come from the region. This is in terms of absolute size. If you look at it, exports as percent of GMP or GDP, the GDP of the local economy, Orange County performs quite well, about 9.5, close to 10% of, Orange County exports close to 10% of its local GMP. The broader metro area does not perform all that well. It ranks fourth in terms of the GMP, fourth behind a number of other MSA areas in California. In fact, it exports only 7.2% of its GDP. So we can do a lot better in terms of the broader area. Orange County is positioned fairly decent here. Now, why do we care? Why am I talking about exports? Why do we actually care about exports? Well, exports support a large number of jobs in the US, in the state of California, and regionally. It also supports a large base of manufacturing, and I'll talk a little bit more about manufacturing in just a little bit because it's important specifically for the region. But in the US, exports support about 9.3 million jobs, 9.2 million jobs. 5.3 million of them are actually in manufacturing. In California, it supports 1.5 million jobs. Over 600,000 of those are in manufacturing. And in the LA metro area, it actually supports 560,000 jobs, which is quite substantial. In fact, it's important to note that in terms of the jobs that are supported by exports, the area, LA metro area, ranks first in the nation. I mean, exports basically support 560,000 jobs in LA metro area. That's almost 10% of the workforce, almost 10% of non-farm payrolls. That's 1 in 10 jobs. And it's more than New York and more than Chicago, more than any other large metropolitan area in the nation. But why are exports important? I mean, you know, the exports matter for two things. They matter for economic growth. They also matter for jobs. And let's kind of look a little bit at numbers here. Well, in terms of economic impact, for every $1 billion increase in exports supports an additional 5,000 jobs regionally. In fact, this is only the direct impact of exports. If you count indirect impact, in other words, if you count the effect of exports on other local businesses, the number is almost double. That's 10,000 jobs for every $1 billion increase in exports. It's quite substantial. Additionally, exports have a large multiplier effect. For every dollar generated in exports, you get a multiplier effect of an additional $1.23 in the local economy. So quite substantial. Exporting jobs are actually better. They offer 15% more pay to their workers than non-exporting jobs. And they offer 11% higher benefits also than non-exporting jobs. Exporting businesses are actually better. They actually are 20 to 30% more productive than non-exporting businesses. They experience about 20% more job growth, as well as they actually have they last longer. They actually have a bankruptcy, they're less likely to fail, they're about a quarter less likely to fail, 25% less likely to fail than non-exporting firms. So it's very important to understand what is the economic impact of exports. But one thing that I want to stress here today, as I mentioned earlier, manufacturing is the key to understanding, to growing our export, to boosting our exports, and in fact, to increasing our presence abroad. Exports and manufacturing output are very closely related. In fact, despite the fact that over the last 4 decades, the U.S. has moved more and more towards a service-based industry, manufacturing still takes the lion's share of our export. Of total, from the US, 67% of our total exports are in manufacturing products. What do we do? What do we export? Manufacturing equipment, manufacturing machinery, transportation, and computers. So it's manufacturing product. 67% of total US are in manufactured products. In California, the ratio is even higher. It's 87% of all our products that are exported from the state of California are actually in manufacturing. And in fact, from 2003 to 2008, California manufacturing exports rose 60% faster than actually the California economy did. So again, they're also a fast-growing industry as well. Of course, exports and manufacturing jobs are also very closely related. Employment is actually more stimulated. It's interesting to see that there's a tighter relationship between manufacturing jobs and export growth rather than manufacturing jobs and GDP growth. So it's actually, statistically speaking, there's a closer relationship there. In fact, exports support a large base of manufacturing in the US. 22% of manufacturing jobs in the US are supported by exports. 25% in California, it's even higher. So 1 in 4 manufacturing jobs in California are actually supported by exports. And here's the thing, and I sort of like this next graph, and I'd like to say that US is still, despite all common belief and common misunderstanding, US is still the largest manufacturer in the world. Look, I always ask my students, I say, what do we produce? And invariably I get the same answer. Well, we don't produce anything and we import everything from China. And then I'm like, that's not true. We got to stop saying this. This is not true. We're still the largest manufacturing force in the world. China is a very close second. And here's what's remarkable about this graph. If you look at the US share of manufacturing, it has stayed remarkably constant over the last 30 years. In 1980, the share of global manufacturing, the share of global manufacturing that came from the US was 22%. It went up to about 22.5% in 1990s. It's now at about 21%. But a remarkable stable range between 21 and 22% over the last 3 decades. This is despite the fact that manufacturing has lost over 7 million jobs during the last 3 decades, almost 40% of its workforce. But nonetheless, in terms of production, we are producing. Some other countries have, China clearly has increased. I mean, China's share of global manufacturing was 4.8% in 1980s. It's now 18%. But China has not risen to the expense of the US. It's actually risen to the expense of some other countries, notably Japan and Germany, which have actually declined, as you can see from the graph over time. So the problem we have is not so much that we're not producing anything. We're producing quite plenty. We're just not exporting as much. And this graph makes that point. US ranks in terms of export intensity, US actually ranked number 15 out of top 15 countries, the largest manufacturer in the world. In fact, if you normalize normalize the world average manufacturing exports at about 100%, our export intensity is only 45% of the world average, so it's much lower. So most of it is actually produced and consumed domestically rather than for international consumption. But we can reverse this trend. And not only we can reverse this trend, But the LA metro area, and Orange County in particular, can be an important factor, can play a key role in this trend, in increasing manufacturing exports to the world. We have the largest manufacturing base in LA County and Orange County. In fact, LA County has the largest manufacturing base in the nation. And this is a little bit counterintuitive because when you think about it, we're not normally associated. It's larger than the manufacturing base of some what's commonly known as industrial states. Our manufacturing base is larger than Pennsylvania or Ohio. And in fact, Orange County, even though despite its small size, Orange County itself is ranked number 10 in the nation in terms of the manufacturing base in the county. And again, ironically, we're having this here at Disneyland Resort. When you think of Orange County, you think of Disneyland. But really, we have a huge manufacturing base in the county, and we should capitalize that. In fact, the LA metro area, in Orange County specifically, is very well positioned to expand, to help the nation, lead the nation in actually expanding exports. We have over 20,000 manufacturing firms in exporting industries within the region. They employ over 500,000 people. And they actually, and the good news is that because of the type of manufacturing that happens in the two-county region, in LA and Orange County, is mostly high-tech, they also pay very well, they pay above average salaries. So again, the region is very well positioned to lead the nation in manufactured products going forward over the next decade. So with that in mind, let me actually sort of go over very quickly, to now that we laid sort of the foundation of why exports are important and where we're headed, let me sort of take a broader view on analysis and offering analysis and forecast for the exports, specifically for the exports in the LA metro area. And as I mentioned earlier, Adrian will actually talk about the Orange County forecast. So here, just to see, well, what are we exporting? Who are we exporting to? Well, let's first take a look at the total volumes. This graph shows the total volumes for LA metro area exports to the world. Obviously, that's been some of the data are available. The last 5 years, not exactly the last 5 years, but from 2005 to 2009, the data is actually available for International Trade Administration, the ITA. That's the solid bars. Now, we needed the historical data, and those we actually had to estimate using our econometric models. And as you can see, the historical estimates sort of pick up fairly well trends in exports that coincide very nicely with the business cycle trends, both domestically as well as internationally. But important thing here to say is that, look, prior to the recession in 2008, the exports from the LA metro area reached a record high of 60 billion. They have actually fell to 51.5 billion in 2009. Who do we actually export to? Well, the largest partners that we have that we export to are Mexico in 2009. Mexico had about 17% of our exports. Canada had an additional 15%. China and Japan with an additional 10% of our exports, and South Korea with an extra 5%. All these 5 countries, the top 5 countries, actually took up 55% of our total exports from the area. The rest went to the rest of the countries, such as Hong Kong, the UK, Germany, and so on. In terms of regions, we are actually the largest exporter to Asia. 37% of our exports went to Asia in 2009, 31% to NAFTA, and about 16% to Europe. In fact, if you actually put together the 3 regions, Asia, NAFTA, and Europe, we have over 85% of our exports going to these 3 main regions. So fairly concentrated. What do we actually export? Well, there are 2 top sectors that we export. The products that we actually export are computer and electronics with about $12 billion, and we have transportation and equipment with an additional $10.6 billion. In fact, together they account for about 43% of our, 43 to 44% of our total exports. So highly concentrated industries as well. And this kind of, and this next, and what I wanted to look here is sort of give you a broader overview about, where we stand within the national picture. Well, we are the largest exporter to South Korea, China, and Taiwan. I mean, and those percentages that you see there, what they show, they actually show that 10% of the total U.S. exports to South Korea originate from this region. 9% of total U.S. exports to China originate here. 7% of all total U.S. exports to Taiwan originate from here. We are the second largest exporter to Japan and Hong Kong, second to New York. Exports by region, we are the largest, as I said earlier, we're the largest exporter to Asia and APAC, and we're the second largest to NAFTA with 16 billion. We're actually second to Detroit. This was in 2009. In 2008, we actually were the first as well to NAFTA. And in terms of export by sector, we are the second largest exporter in the nation in terms of computers and electronics, and this is after Silicon Valley, so, which makes sense. And we're the second largest in transportation equipment after Detroit. Again, makes sense. So again, large exporting from the region and a lot of growth to happen still to come in the area, right? So what do we think about the exports? Where do we see this happen? What do we see happening over the forecast horizon? Well, we project strong growth. We project strong growth in 2010. We actually had to forecast 2010. 2010 data will not become available by the ITA until middle of next year. So again, they're about a year and a half lag in terms of data. We project strong growth in 2010 and throughout the forecast horizon. In fact, our projections show that the area had already recovered everything that was lost during the recession. We got back to 61.7 billion. And in fact, in 2000, we'll continue to grow, exports will continue to grow over the forecast horizon, reaching over 81 billion in 2013. It's easier to kind of take a more detailed look at the actual growth rates. In 2009, exports collapsed pretty much by 14.1%. Okay, we're projecting a growth rate of close to 20% in 2010, as I mentioned earlier. And we project, however, we project positive growth rate, but more moderate growth rate in 2011 and 2012, and a little bit and a stronger pickup in 2013. And the sort of more moderate growth rate has to do with the fact of the slowing of the global economy. First of all, it's the weak recovery in advanced economies, as well as the slowing of emerging economies and troubles from the Eurozone. So that's what this is all picking. We also project that exports to the region, to the specific region, will increase over the forecast horizon. The largest gain will go, the area that will grow the most will be Asia. In fact, in Asia, we project a 64% increase from 2009 till 2013, so quite substantial, especially with the signing of the South Korean treaty and so on. Same story with the transportation and the two largest, in terms of sectors, the two largest sectors we project are computers and electronic. They'll continue to grow. Computer electronic reaching about 18.2 billion by the end of 2013, and transportation equipment reaching about 17.1 billion, again, by 2013. And with that in mind, I'll turn it over to Adrian with more specific details for Orange County, and I'll meet you here for questions. Thank you.
Good afternoon, everyone, and thank you for coming. Thank you, Mira. Please note that after this session, you'll be able to collect a handout, an actual report that has all our data and all our numbers in. So there's no need to memorize everything. If you do, that's fine, because then Mira and I won't be the only two who know all these fine and exciting statistics. So merchandise exports, very important for Orange County. Now, for the Long Beach Center and LA area, there is data. There's data from 2005 through 2009, as Mira had mentioned. Data for 2010 is not out yet. That will be out next year. So we had to estimate the data for 2010, and then the projections going forward to 11, 12, and 13, as well as the historical data. For Orange County, there is nothing. We had to estimate everything and the projections. And what I'm going to do is I'll talk about the methodology later on, because I know you all want to really hear about that. That's why you're here. And I'll also show you some of the main results. So merchandise exports, very important to Orange County. In 2009, merchandise exports, 16.7 billion. 16.7 billion. Now, that's a substantial amount, because if you look back at 1990, is only 5.7 billion. So it's gone up substantially, 5.7 billion to 16.7 billion. But that wasn't the highest year. The best year was 2008, 19.6 billion. So 2008 was great, and then, of course, global recession kind of slowed things down. Now, in the projections, which I'll show in a minute, for 2010, it'll be over 20 billion. So compared to 2008, which is the 19.6, it's going to be roughly about 20 billion. So we're going to get slightly above what we were in 2008. But the big thing is the fall from 2008 to 2009, from 19.6 billion to that 16 billion. That was a 14.9% decline. So that was devastating for Orange County. If you look back at our historical data, the growth rates there were 9.9 to 13.5%. So we were growing pretty substantially historically until obviously the worldwide slowdown occurred. So here are projections. In 2010, 20 billion. So that's up from the 19 billion in 2008. So we're just above that level. And then it increases by, we're estimating about 1.5 billion to 2.5 billion per year. So 22 billion in 2011, 24, and then 26.9 billion, almost 27 billion by 2013. So that's a pretty nice increase. Percentage-wise, we had that 14.9% decline in 2009. 2010, that's going back up to that 20 billion. It's a 20.8% increase, which looks like a significant amount, and of course it is compared to last year. But compared to 2008, if we're comparing 2010 to 2008, that's a 2.8% growth. So historically, we were growing at 9.9 to 13.5%. That's only a 2.5% growth rate. And then increasing 12.9%, and by 2013, that's a 10.1% increase compared to 2012. So some nice growth there, and obviously that's going to be very good for our region here. What about countries? Well, the most important country where most of our exports go is Mexico, and then Canada, China, Japan, and South Korea. Now, if you're looking at California, what are the top 10 countries? Mexico, Canada, China, Japan, and South Korea. So the top 5 are the same ones for Orange County. You know, Germany is not surprised, maybe perhaps surprising to some, is not in the top 5 for Orange County. Although a big region and obviously involved in a lot of trade, it's not where most of our exports go. For Orange County, we've got 2.6 billion going to Mexico, over 2 billion going to Canada, so those are the top 2. And then China and Japan, about 1.4 billion. So again, a substantial amount. And then South Korea, 793 million, just under 800 million. So not over a billion, but still a good amount. Now, historically, if you look at the growth rates, 2007, 2008, 2009. 2007, 2008, economy was booming. You'd expect exports to increase to countries. And if you look at the left-hand side on the bottom there, that's Canada. 36% growth rate in 2007, 9% in 2008, and then a sharp decrease, 23%, in 2009. But as for Mexico, that was different. Kind of reversed some things around there. In 2009, exports fell to Mexico by 11%. But in 2009, there was a sharp increase, 13% increase. So when you're looking at exports, there's a lot of things that are going on. It depends on what's happening in the world economy, and it also depends on what's happening in a particular country. So some countries can experience a lot of growth, and others, exports can be falling. China and Japan are interesting because if you're going back to 1999, you compare China to Japan, Japan had way more exports. Our exports were going a lot more to Japan. From 2000, we have been on a downward trend, exports to Japan, whereas China, exports have been increasing. It's on an upward trend. And they're kind of converging now. So while there used to be a wide gap between them, they've now converged. As for the forecast for the countries, on the bottom left is Canada. We estimate for 2010, 2.3 billion. It'll increase by just under $1 billion by the time we reach 2013. So it'll go from 2.3 to 3.2 billion. As for Mexico, and that's on the bottom right, 2.9 billion in 2010 is our estimate for last year, and increasing to 3.9, so almost $1 billion. So that's also a significant increase. China and Japan will be over 2 billion by 2013. So these are good signs for Orange County that we'll see our exports increasing. What about regions? Well, we export, obviously, all over the world, Africa, NAFTA, European Union, South America. And you'd think that, well, with Mexico and Canada being our top places of exports, that perhaps NAFTA would be the biggest region. Well, it's actually Asia. So we do export a lot to Japan, China, South Korea, and lots of other Asian countries. So in 2009, we estimate about 5.6 billion went to Asia. NAFTA, 4.7 billion. So still a substantial amount. Now the European Union, another interesting region, 2.4 billion. So there's a considerable amount of exports going to the European Union. Hopefully things will get better there. Maybe there's another meeting and promises about things are going to be better in the future, which will be broken next week. We also export to South Korea, APEC, and Africa quite a lot. Now, the recession hit these regions differently. So the top line is Asia, 2009, 5.6 billion, 9.3 billion is our projection for 2013. Asia was hit pretty hard by the global recession, but then it recovered pretty sharply. Focusing on NAFTA, the middle line, 4.7 billion, increasing to 7 billion by 2013. So although we didn't fall off as much, our exports to NAFTA, the recovery is not as sharp as it was to Asia. And then the European Union, slight fall off, and then just a moderate recovery. So not a whole lot of growth, 2.4 to 3.6 billion by 2013. What sectors? Well, there's a lot of high-tech machinery, transportation equipment. For California, the top sector by far, computer and electronics, 43 billion worth of exports. That's quite a bit. I think the rest doesn't really matter comparatively speaking. But obviously 14 billion is, in machinery is still a substantial amount, and transportation equipment. There are three shaded bars there: agricultural, waste and scrap, and plastic and rubber. Those, while they're top exports to California, they're not top exports in Orange County. So those aren't as significant for Orange County. For us here in Orange County, computer and electronic products, 3.8 billion, transportation equipment, 3.3 billion. So those are our top two sectors. Miscellaneous is 1.2 billion. Miscellaneous, medical equipment, sporting goods, jewelry and toys. Maybe we shouldn't export those stuff so quickly. I know some people who really like that, especially at this time of the year. Also chemical, 1 billion. As for the projections, kind of interesting, the computer and electronics, we have that estimated going up to 6 billion by 2013. So substantial increase from 3.8 to 6 billion. For transportation equipment, going from 3.3 billion up to 5.5 billion. But if you had stepped back to 2008, transportation equipment exports were greater than in computer and electronic products. And it might have been tempting at that time to project that transportation equipment would be maybe 7.5 to 8 billion. But with the recession, things turned around, and we're only projecting 5.5 billion. And then miscellaneous going from 1.2 billion to 2 billion, a small increase in miscellaneous exports. Now, the reason why you came, methodology. So I'll talk briefly about the methodology, because I'm getting a sign. Well, I don't wear a watch, so I don't even know what that means anymore. But I'll go through quickly. We use regional, national, international data. There are exchange rates, labor productivity. We look at economic growth across countries, exports. We have a lot of data that we can use. And then we use the statistical modeling, and we set up various models, and we put across equation restrictions, and then we evaluate the models and make sure that they're predicting accurately, which they were, I can assure you on that. That's why we're here again. There are 3 different data sets that are available. The one that we use is the origin of movement, which shows where the merchandise export starts and to its export port. The exporter locator data, that's no longer available. That was by zip code, and that data went out from 1993 to 2002. Custom districts data, very nice, very detailed data, but that just says, here's what went out of Long Beach, here's what went out of LA port. Doesn't matter where it came from, whether it came from California, Arizona. So that's why we use the origin of movement data. So we have data from countries, geographic regions, product type. The national data, that's the most, that data goes up from 1989 through 2010. So we have the most data for the whole of the US. There's less data by state, but still goes from 1999 to 2010. The big problem with the data is that for the metro areas, there's not a whole lot of data, and it's only available up to 2009. So they haven't even given estimates for 2010 yet. So that's why we had to estimate that. So that was one of the main contributions here, is that we give you more up-to-date data. So let me end up off on a positive note, and then I'll invite Mira up to come and answer some questions. So 2010, we estimate 20 billion. That's up from the 2009, up 20%, just above what we had in 2008. It's going to grow by about 1.5 to 2.5 billion every year. So 22 billion in 2011, 24 billion by 2012, 2013, maybe even reaching 27 billion. As for the growth rates, 2011, 12.9%, 7.2% for 2012, 10.1% for 2013. Not quite the 13% growth rates that we've had historically, but nonetheless still pretty good. So as far as Orange County is concerned, exports looks like a very good region for growth for our county. So I'll invite Mira up, or you can sit there.
Just wherever the...
and we'll answer any questions.
My name is Ben. I think all the data are really nice. Orange County have a lot of hope now. But I think one data maybe you can consider about 10 days ago, we celebrated for the FTA, Free Trade Agreement with 3 countries. Yep. One is Korea. Mm-hmm. So Korea will be substantial increase for next 10 years. Besides, Orange County has larger Korean population. Why I say that? You look around urban everywhere, the second largest one. Why? For example, the outside of Korea had the largest Korean church is in Orange County, Anaheim. That is the largest immigrant church in the United States. It's in Orange County. I belong to the church, so I know. I'm Chinese. But I would say the next 10 years, the South Korea was supposed to increase the number, this one.
No, that's yeah, absolutely. That's actually a very good point, and I agree with you. So South Korea, well, the U.S. Congress just ratified that treaty in October, basically, with three countries: South Korea, Panama, and Colombia. It is not. It's reflected here quite a bit. The reason why one of that large increase in exports to Asia, for example, occurred is because the large part of it is due to South Korea. The reason why you don't see as much of an, and we're projecting further out, in fact, our longer term projections show a much larger increase beyond 2013, show a much larger increase to Korea. And the reason being is that a lot of that treaty, the treaty was just ratified. It'll take about 5 years until all of the tariffs are actually, 95% of the tariffs are actually going to be removed, but it takes time to get there. So that doesn't capture fully, is not captured fully within this forecast, but nonetheless, absolutely correct. It will, if the horizon was longer, our longer term forecasts are way, I mean, the growth rate to Korea are actually exploding, assuming the currency behaves, so the dollar behaves, so.
Hi, I actually have two unrelated questions. I found the one chart showing, I don't know what terminology you used, but it was showing the utilization, and Taiwan was hugely at the top. And we don't hear much about Taiwan anymore. And the suggestion is that they're making a lot of stuff and it's selling it everywhere else. We hear a lot about China, and of course it goes in the basket. You know, I'm just curious if you might want to comment on that Taiwan component.
The chart you're referring to, if I'm not mistaken, is the one with export intensity. Yeah. Taiwan is, if you look at, so the world, in that chart, the world average is basically normalized to be 100%. It's just a number for convenience so that you can compare things. U.S., in terms of manufactured products and in terms of export intensity of those manufactured products, falls far behind. As you saw, it was number 13 on the top, number 15 out of top 15, so it's 45%. Taiwan, I think it's close to 250%. I mean, if you look at the scale that I've used. And the reason being, and you're absolutely correct, Taiwan is grown over the last 4 decades based on high-tech manufacturing. In fact, I mean, if I were to compare Taiwan and what we do in the region here locally in Orange County as well as in LA metro area, the right comparison, if you want to think about competitiveness, I say that would be the closest competitive to us rather than China or even Vietnam, which is now becoming the manufacturer, sort of the manufacturing base for lower, so the less high tech, sort of the less sophisticated products. But Taiwan is actually, I think we should keep an eye out. I mean, it's always been, it's got a strong manufacturing base, computers and electronics. It could be, there are competitors, but we could potentially use them as a complement to us. If we regionally restructure our industry so that we take their intermediate goods and we actually continue to do our high-tech manufacturing here, then you can even look at that as sort of complementary. But for now, I think this is longer-term plan, 2 to 3 decades. But for now, I think they're actually I think the best competitor that we can think of for the region, especially for Orange County, is probably Taiwan. Good.
Hi, I'm Kristen Houston with the U.S. Commercial Service, and great presentation, very interesting. And you did reference manufacturing in most of your slides. I work largely with franchises and apparel companies, and I wondered if there's interest or how can you talk to capturing that data, particularly with, I think, 80% of the growth in the U.S. is coming from the services industry, such as, licensing, travel and tourism, other services, IP. And when you sell a round table pizza into Vietnam or a Curves workout for women into India, you have tens of millions of dollars coming back in revenue. So can you address how to capture that data? Is that being studied at all?
Excuse me.
We do have some data. We have limited data available. There is some data on apparel. Apparel, It's an important component, but it didn't make it into the top 15, so we didn't project on that. But we do have data, and we could project out on apparel.
Well, it's not just, your question was actually broader for services. There's a problem with services, and it goes as follows: is the data are actually, it's very hard to track, and of course when you talk about services, you talk about, as you said, leisure, hospitality, you talk about consulting, you talk about legal, you talk about accounting, engineering, and so on. The data is actually hard to come by. Our bigger goal, this is the second year we're doing this, and in fact we expanded this more this year compared to the previous year, and our goal is to basically get to a database where we can actually answer that question more directly. I mean, I can give you off the top of my head, I know a third of our exports from the U.S. are in services. So 67% is manufacturing, the rest, 33%, is services. In California, it's less. And my sense is, and I don't have concrete data to base it on, but my sense is the vast majority, there are two areas, obviously, where those services come from. One is the San Jose area and the San Francisco area, and then the other one, the other center is LA. We rank second, I believe, in California, based on what my research I've done, in terms of service exports abroad, second to San Francisco. Whereas for goods and service, for merchandise exports, we're number one. But the data is a little bit hard. I agree with you. This will be a more complete study if you actually have the entire data set, including services. Services, as I showed earlier, I mean, in California is not a big problem because, again, 87% of our exports are mostly merchandise exports in goods. Services made up 13%. In other words, what California services are actually that we export are actually are less than the average U.S. services. What gets exported from California. So we're missing some, obviously. We're missing a 13% from the state, but it's not as much as it would be. It's a bigger problem, I guess, national. That's what I'm trying to say. So, but that's us working towards a more complete data set, and it will take a bit of time and a bit more years to actually build it. So.
How you doing?
Good.
I just wanted to say great presentation also. My question is, I've seen a couple times on the topics having arisen within like U.S. politics, where within the economics of the U.S.-China relations, pointing out towards China's devaluation of their currency. And my question is, what do you think or believe are some of the short-term as well as long-term effects related to their devaluating of their own currency and how that affects businesses as well as the countries both on each side? Because my concern related to that is that it seems that obviously some groups are going to benefit and some groups will not, but I kind of get the interpretation from it that it's done in order to kind of lower the goods, the value of the goods, and but I don't really see that helping out, say for example, the Chinese businesses, if their currency is being devalued, because if they're selling their products at a lot lower rate than it should be, then how do they actually benefit through that in the long run?
So let me kind of answer it in two parts. What do our forecasts include? I mean, and then we'll get into the more specific discussion. In terms of what we assume for this forecast, we did assume, look, China's currency is clearly overvalued. I mean, you don't want to say, it's for political reasons, you don't have to say it openly, but it's estimates in a range of 30 to 40%. This helps their exports because it makes their goods cheaper to us. I mean, it's a very clear sort of, it's not a convoluted sort of idea how they get to actually sell for cheap. They sell for cheaper, that they employ more people, that generates growth for them. Now, in our forecast, we assume, and I think it's a fair assumption to make, China is going to devalue when China is good and ready. The Chinese banking sector is not as strong, obviously. It's still very, very much government control. And they're worried about, and rightfully so I think to a certain extent, they're worried about speculative money flowing into the country that could potentially wreck the banking system. So they're not going to devalue right away. However, within our forecast, we assume there is a range-bound depreciation, sort of steady depreciation of depreciation of the dollar vis-a-vis the yuan. I mean, and that's what's reflected here. It's not a collapse. It's not that China is going to liberalize its currency tomorrow. because I think it's unrealistic to assume so. But we're actually assume every year about 2 to 3%. 1 to 2, it depends. It starts out early, 1 to 2% early in 2011, I believe, if I remember my numbers correctly. 2 to 3% in 2012 and 2013. Sort of a steady depreciation of the dollar versus the yuan. And one of the reasons for that is obviously political pressure. It's become now a political football, and it's been discussed also in Congress. So I believe China will move a little bit, but obviously they're not going to let it free float. Not in a foreseeable future. Not over the forecast horizon at the minimum that we're dealing with here. So, okay. I hope I answered the question. I mean, that's the forecast. That's what the forecast is actually representing. So.
Okay.
Okay.
I think
Thank you.
That's it. And thank you to Mira and